Hello and welcome. This is BloombergQuint. This is our special show on futures and options and how to approach, well, options specifically in this case. And joining us to talk to us about this particular aspect is a very special guest we have with us, Anthony Saliba, the CEO of Matrix Holding Group. Now, I'm sure a lot of you out there will not need too much of an introduction because we know that Tony has been in the markets for about 40 years now, and we're very well versed specifically with options trades. Anthony, thanks so much for joining us. It's an absolute pleasure to have you with us here.
My pleasure. Thank you very much.
I'm going to start off with just the basics, and well, my question is to do with position sizing and risk. It's something that a lot of traders, well, many who have even some experience, struggle with. What can you tell us about that?
Well, money management, as we would call it, is very important. In trading options, a lot of people will look at pricing theory and understanding theoretical valuation, but not all of us have the same amount of capital to trade with, and risk management starts with money management or position sizing, right, and the ability to scale into a position that is most suitable for your capital. It takes a bit of analysis. There's some good pieces written about it. I have a few manuals that I've written over the years that talk about how you work backwards into what your first trade should be.
Right.
And thus that, as you said before, a lot of people look at how much they want to make, but they don't look at how much they can afford to lose.
Right. So in that case, Tony, once you have the quantity that you're willing to lose and the quantity that you're willing to stake, how do you scale in and scale out of these positions?
Well, so it's very numerical in the case of taking your capital at risk and being able to, well, first of all, you don't necessarily only have one trade you're looking at. You may be putting on trades in a number of different names or in a number of different strategies. So it's a pyramid of a macro into a micro strategy. So that analysis will be individual to each person's desire. But I was making a trade a couple weeks ago where I basically started with about 5% of what I wanted to allocate to that position. Went against me a little bit, and I ended up only having about 20% on of what I wanted to trade, but it worked out pricing-wise and went my direction. So.
All right. All right. Well, now many of you may know that Tony is also featured in, well, the first Markets Wizard by Jack Schwager, and there are a lot of insights that you can take, especially if you are an options trader. But Tony, you have made a point of preparedness. It's something that I have come through in a lot of your conversations, homework and preparedness. A lot of that also has to do with insurance, having a backup. If you take that into consideration, firstly, if you could just tell me what would you tell someone who sells options on a naked basis? Mm-hmm. And secondly, how would you go about setting up an insurance here?
Right. So selling options is opposite of what I have made my money, and typically would, I'm a low risk, a risk averse, and I pay the penalty in time decay. But those who, and it's very much in vogue over the last 10 years with this grinding, always up market, particularly in the U.S. market, to sell premium and to let time decay work for you. So the number one strategy, or the number one thing to think about, is to spread that, be ready to spread that position should it start to go against you.
Right.
Okay. So hopefully the options that you're selling have some decent size to them where there's another option, a call or put out of the money that you could utilize.
Right.
But more to your point about preparation, the homework you would do in that case in terms of selling options would be to look at spreads, what spread positions would be reasonable should you have to use that insurance and back up, turning a short put into a short put vertical, for instance.
Right. Okay. And in converse, say for example, people were simply long in certain options, and there is always the aspect of time decay working against them. What would your advice be to them?
Okay, so that's something I have a lot more experience in. And in terms of a more active professional or semi-professional trader, the way that we would offset or combat time decay would be trading around it, which we would call gamma scalping, but that's expensive when you're trading in a retail account, and also somewhat difficult to do remotely without order flow coming to you, changing bids and offers on the screen in the marketplace. So the secondary way to handle trading against time decay would be to put on another position that works in your favor should time decay become very extreme.
Sure.
So possibly, buying a calendar spread or selling a out of the money vertical that would not add too much risk to the position, but would also pick up some theta should your position not work for you.
Okay, fair enough, Tony. Also then, I'm sure you have worked with a lot of traders, and some of them may be new into the markets. Some of them, may go through certain losing streaks, if I can call them. I know that you hedge your bets here, but you still make certain amount of losses. And they may be small, but psychologically they may, have certain impact. What do you tell them through the
right.
losing streaks?
So the first start is to address the proper money management to help eliminate a losing streak that is catastrophic to
Right.
your. You need capital to be able to continue to trade. Unfortunately, if you blow through all your capital and you don't have a way out, that's a different problem in and of itself. But just dealing with a losing streak within your capital base and not losing your nerve, if you will, or your interest to continue to trade, the first thing that we would do is reduce your size. And it's the old saying, if you fall off the horse or bicycle, you get back on, and that eliminates that fear. I wouldn't stop trading. I
Right.
would just reduce my size, okay?
Right.
And if I did a lot of homework when I traded, and we still preach doing a lot of homework, meaning even if you're trading algorithmically with systems, to review what's happening and to learn from that. So from that standpoint, if you're seeing a pattern of your losses in terms of a certain type of strategy,
Right.
to maybe change up that strategy.
Right. But just a couple more questions, Tony. There's also this battle between technical analysis and fundamental analysis. Some may say that you should be using both. Where do you stand in this picture?
It's a great question. We were talking about that before we came on air, and that is that the old saying that if I had tomorrow's Wall Street Journal today, then I could retire. Okay,
Right.
So it's all about pricing.
Right.
And the technical analysis gives it to you right now, today, and I think the majority of your viewers are more of a short-term
Sure.
trading.
Right.
And so the technical analysis is much more beneficial for those type of traders.
Right.
Fundamental analysis, obviously, which when I began and came up in the industry was really all that we had, and technical analysis was just beginning with Dow theory and such. But the fundamental analysis, more of a macro approach, it's good to have that and good to know that. Then your time frame is a little bit longer, right?
Right.
And you're more investing. Except for when it comes around earnings season, then
Sure.
the two kind of combine. But I'm a much bigger fan of the technical analysis.
Okay, but so in earnings season, you clearly have to consider the fact that there could be an increased volatility in prices, and thereby you base your strategies based on that.
Exactly, and you
Yes.
touched on the proper term there. Volatility analysis
Right.
is also, and you're not going to have as much fundamental volatility analysis as you will technical volatility analysis.
Right. A final question then, Tony. Over the past 10 years, how has trading changed in terms of trader psychology, and what has technology done for it? And how do you see things progress? Well, how do you see where will it be about 5 years down the line?
So I tell my people when I die on my tombstone, the epitaph will be necessity was the mother of invention. And basically, all the things that I've done over the last 30 years have been based on a necessity in the marketplace. And technology has played a huge role in that. And I've spent most of the last 20 years bringing technological solutions from professional traders to institutional traders and now retail traders. So the last 10 years, there's been a lot of reflection in terms of professional trading after the 2008 crisis, but technology continues to march forward, bringing professional tools at lower costs and faster speeds to private individuals and prop traders that like never before. So I see a lot of change, particularly in option spreads. That's really where we're seeing the most tools, and then also idea generation.
All right. Well, there you have it. And for those who don't know, well, Tony is actually here to attend the 2019 CMT Summit, which is here in Mumbai. So don't forget to, well, take a look at that as well. But on that note, we conclude this conversation. Tony, thank you so much for joining us and speaking to us here on BloombergQuint. It was an absolute pleasure.
Thank you. I'm honored. Thank you.
Thank you.